So yeah, Parkway Minerals. We're a company focused on the fertiliser sector of the resource industry and feedstocks to the fertiliser area, with a number of projects now in Western Australia and a significant investment in Europe. A disclaimer, there's a number of resource statements in here and statements about process development backed up by various competent people as included there. So I'll run through the company, talk a bit about the fertiliser industry, and then our projects in Western Australia and Germany, and then the value proposition. What's the key selling point for Parkway Minerals? Why should you invest in the company now? Company's now got about 350 million shares on issue, share price of about 1 cent. Like a lot of small caps, it's declined significantly over the last 5 years. Market cap about $3.5 million. A board of directors who understand project development in resources in the small area. Adrian Griffin, our chairman, has started a number of companies from initial concept through IPOs, feasibilities, and then on into production or takeovers. My background is in industrial minerals, in project development and operations. Chu is a financier based in Singapore and has brought in a number of investors. About 30% of the company is owned by a range of Singaporean and Malaysian investors. Natalia Streltsova is a technical business development specialist, recently moved from executive roles to non-executive. Her last executive role was with Vale for business development, where she was responsible for their potash and phosphate investments in Brazil. We have a number of projects on the go. We have a shareholding in Davenport Resources that I'll touch on, a significant project in the Dandaragan Trough, a salt lake, Lake Bali in Western Australia, and some technology as well that's got a shareholding in Lithium Australia. And what we're trying to do, all in the fertiliser space, Salt Lake, Lake Bali, a very large green sand deposit in the Dandaragan Trough north of Perth that's prospective for both phosphates and potash, and a significant shareholding in a potash exploration project in Germany. A few slides about the fertiliser industry. 3 elements. You need hundreds of kilograms per hectare per year for plants to grow properly. N, P and K. We're looking at the P and K part, phosphorus and potassium. They're not interchangeable. You need the right amount of each one to get the maximum output from your plants. And there are minor components as well. Calcium, sulphur, magnesium are the main ones, but also iron, zinc, selenium, and so on. Most soils, certainly in Australia, are depleted in N, P and K. As plants grow, they take those out of the soil and we export them from the farm. And to maximise growth, most parts of the world need to use more fertiliser, not less. There's some photographs there of what happens if you don't have either phosphates, the plants don't grow strong, or without potassium, the fruits don't grow large. So for strong plants that are obviously also vital for healthy fruits, you need phosphates, and to get the maximum size of fruit, you need potassium. What's the outlook for fertiliser? And in the macro sense, it's a very important component of feeding the world. Food production or food demand rather, is predicted to double by 2050, driven by a number of things. World population growing, forecast from about 7 billion now to 9.5 to 10.5 billion people. Arable land per person is going to go from about 0.25 hectares per person to 0.15. Added to that, the increase in demand for meat from the developing countries of the world, particularly India and China with those big populations, will increase the agricultural pressure significantly. As an interesting aside, as Mel was saying in the previous presentation about pork being the biggest meat requirement in the world, this little graphic down here shows the demand or the consumption of pork in China over the last 40 years compared to USA. So you can see the increase in meat consumption in those developing worlds is behaving exactly the same as it has in Western Europe and USA. So USA stable. China has increased from about 8 million tonnes a year to about 65 million tonnes a year in that period. There's a nice quote there about the challenge to feed the population with less area and a lot more efficiently. There are a number of things that can be done to improve the food supply chain, but the accurate use of fertiliser is one of the low-hanging fruits in terms of the best return for your dollar in the agricultural supply chain. It's a big business, about $180 billion a year now. Nitrogen is about half of that, and the nitrogen plants are wherever you can get hydrogen cheaply, because nitrogen is 80% of air. So they make ammonia, and you have that in a lot of gas fields and also sometimes from coal. The biggest nitrogen plant in the world is actually in the Pilbara now in Western Australia, where Yarra Pilbara Fertilisers extracts it using gas from the North West Shelf. Phosphates are about 30% of the business, so about a $50 billion a year business, and potash about 20%, so around about $30 billion. They're very different commodities. They all come together in the end to support the farmers, but where they come from is very different. Phosphates are produced in about nearly 60 countries throughout the world, but a lot of it is consumed internally. So in terms of the internationally traded phosphate market, it's dominated by Morocco and Saudi Arabia. And Morocco is the big producer worldwide and also has far and away the world's biggest reserve load. About 70% of the reserves of phosphate are held in Morocco. Also, the demand for phosphates has grown substantially over the last 40 years as agriculture has tended to industrialisation and increased production. Asia is fairly well balanced. China is a big producer and quite a big exporter. Australia is pretty well balanced, but that's all in Eastern Australia. So Western Australia, Malaysia, Indonesia and India basically import all of their demands for both phosphates and potash. So there's a ready local market for the products we're looking to produce. By contrast to phosphates, potash production is concentrated in two regions of the world, Saskatchewan in North America and Russia and Belarus in Eastern Europe. And that's five companies produce about 80% of the world's potash. Demand in Asia is very high and there's very little local production. These two regions used to operate as two cartels. North America still does. There's one company owned by the three majors that manages all of the sales and exports out of North America. In Eastern Europe, the Belarus Potash Corporation used to manage the sales for themselves and Uralkali. That broke down in 2013, and over the last few years there's been a marketing war. So the price of MOP, which is about 80% of the potash production, has gone down from about $400 a tonne to around about $250. It's slowly recovering from that, and the latest sales have been in the higher 200s. The products we'd be producing in WA, though, are the sulphate of potash, which hasn't had the same impact on pricing. So with that as the backdrop of fertiliser, the project we're working on at the moment is Lake Barley, located in the central part of Western Australia, and there are a number of companies looking at salt lakes as a source of sulphate of potash in Western Australia. This land we've taken that about the middle of last year as exploration licences. but had the opportunity to buy that licence, granted exploration licence in the middle in January this year. We went as God's payment to people. It's a salt lake, so it's an arid environment, but the last 6 months has been 2 1-in-20-year rainfall events. So our salt lake has been awash with water for some time, but we've been out in April, could only get to around this peninsula, but sampled the surface meters, and that's got good values of potassium in it. So it's looking as a reasonable target. Our next steps on that is to do a geophysical survey to identify the paleo channels within the lake and follow up from that with a drilling program. That drilling will be done in December. The work on this lake will be funded with our current cash reserves. Our second project, which is the one we've been working on for about 5 years, is the Dinner Hill project within the Dandaragan Trough. That's the Dandaragan Trough, which is a big sedimentary basin just north of Perth. It's about 150 kilometres north-south, 30 or 40 kilometres east-west. So it's a very large deposit, very good infrastructure, rail, high voltage power, roads, water. It's freehold farmland, which means two things. There's no native title and very little native vegetation left on the deposits. We're focusing on the northern area here. That's Dinner Hill, where we've drilled out our first resource. So we've got an indicated resource on that. The material looks like this. So it's free-running sand. From this particular slide shows from the surface to the bottom of the hole. Each one of these squares is 2 metres, so it's about 110 metres deep. Contains 2 layers of green sand, separated by a layer of chalk. So the green sand starts there, all the way through to there, then chalk, and another layer. In and around the chalk, there's these phosphate nodules. Our objective when we started was to look at this green sand material for potash. We realised, though, there was also an opportunity to produce phosphates. So we basically have 2 overlapping resources in the same sequence. We've done studies on both phosphates and potash. That's the phosphate flow sheet. We've done a scoping study mining at 4 million tonnes a year. That was reported shown there in September 2015. It's a strong project, capital requirement of about $200 million, but generates about $50 million a year of EBITDA. It works because, one, it's unconsolidated sand, so mining is very low cost. Separating out the phosphate nodules from the ore is, again, low energy. We are located less than 200 kilometres from the export ports and the fertiliser plants by existing multi-use rail. So the infrastructure capital is very low, and the operating costs are low because of our location. The second stage is the real attraction for Dinner Hill, though. That's taking the extensive green sand deposits, extracting the glauconite, and producing not just potash, but phosphoric acid, which is a key fertiliser element, and alum, which is used in water treatment. That's got a higher capital cost, but generates an EBITDA of over $250 million a year. A development timeline, approximately 2 years to complete the feasibility study, including permitting, and we're looking for a joint venture partner to come in here and support this. The estimated cost there is about $10 million, so given our market cap of less than $5 million, that's not really attractive for our existing shareholders. So we're investigating areas to bring in a joint venture partner. They, depending on their objectives, they may bring forward the KMAX pre-feasibility study or may leave that out there to be developed with the free cash flow from stage 1. The KMAX technology we've developed is patented, owned 100% by Parkway Minerals. Can be used on other high grades potassium-bearing silicates, and we've talked to some people about licensing that opportunity. We also own some shares now in Lithium Australia. Came out of our ownership of Kmax, where we held shares in Lepidico. As part of a takeover bid, we agreed to sell them to Lithium Australia, so we now have about $900,000 worth of shares in that company. Our other major holding is Davenport Resources, where we hold 26% of that company, plus the right to some milestone shares as well on achieving certain objectives. It's in central Germany, the province of Thuringia, which is a very old potash producing area called the South Harz region. This shows that in a little bit more detail. Chris Bain, who's the MD of Davenport, will be presenting this afternoon, so I won't go into this in much detail. But it's been mined very successfully between 1960 and 1990 in the old Soviet East Germany. Over 100 million tonnes of potash came out in that period. These areas were planned as future mining areas in that time. After reunification, that industry there was heavily dislocated, went from 5 mines and 45,000 employees to 2 mines and 5,000 employees within 18 months. So significant cutbacks. Price of potash at that time was well below $100 a tonne. So that area has been forgotten about, and we're coming back here working with a significant amount of existing data. They've been drilled in the 60s to the 80s, and we believe we will get to an inferred resource within the next 18 months at a relatively low cost. Peers, I won't go into this in any detail. There's Parkway Minerals, down about 4 million market cap. A number of Salt Lake companies, Australian Potash, Reward Minerals, around about 20-30 million market cap. Salt Lake, Callium and Agrimin, all above $60 million market cap. So there's Salt Lake peers, we have some room to grow. And similarly for Davenport, we have Highfield Resources, who are about 5 years ahead of them in northern Spain. So the last slide, I think, is what's the value proposition for Parkway Minerals? Well, it's not the best statement to make, but we're very low value, or very cheap at the moment. Got $2 million in the bank. Our shareholding in Parkway is about 2 million. Our shareholding in Lithium Australia is about 0.9. We have a number of projects we're working on with milestones we can achieve within our current cash position. So we expect to see a significant technical success over the next 6 to 9 months at Lake Barley. Davenport is working strongly on their projects, so we can see a change there. So between Lake Barley, Davenport shareholding, our Dinner Hill project within the Dandaragan Trough, and our exposure to lithium by Lithium Australia, we think we make a pretty compelling value proposition at the moment. So thank you very much.